Welcome to ET Money Ask the Expert session. Today, we are joined by Mr. Prateek Oswal, Head Passive Funds, Motilal Oswal Mutual Fund. World's biggest mutual fund is an index fund. However, in India, most investors are either unaware of these type of funds, and if they are aware, still tend to go for actively managed funds. Although there has been some change in this behavior over the last couple of years, index funds in India are still a very small category. In this video, we'll decode index funds with Prateek, look at the risks and advantages of approach these funds follow, and how you as an investor should make a decision on whether to go for these funds or not. Prateek, thank you for taking out time and talking to us.
Yeah, thank you, Rajat, and thank you, ET Money, for having me out here. I look forward to this discussion.
When we say an index fund, what is that index in that index fund, and how do these funds then use this index to decide how and where to invest?
Yeah. Thanks, Rajat. So, so typically, I think there's two styles of investing. One is called active investing, and the other one is called passive investing. In active investing, you're actually giving your money to a professional fund manager who's using his skills and his knowledge and experience to try to figure out which are the best stocks to buy and which are the worst stocks to sell. So that's active management, which obviously is very prominent, and that's where most of the money is being invested. The other side of investing, at least in mutual funds, is called passive investing. And in passive investing, what you're doing is you're trying to your investment strategy is to not actually give money to a particular fund manager. In fact, there is no fund manager. The idea behind a passive strategy is for you to replicate the returns of the index. So by index, what do I mean? So I'm sure a lot of you would have heard of a Sensex or a Nifty. So Nifty is basically the top 50 stocks in the country. And the Sensex is the top 30 stocks in the country. So what the Nifty does is gives you an average view about where the market is going. So the whole point about index fund is actually to give you exposure to the returns of the Nifty. So the Nifty is up, say 10%. Your portfolio in a Nifty 50 index fund will also be up around 10%. So how it works is that as an AMC, as a mutual fund, what we do is whenever we get cash in from our investors, we actually buy the top 50 stocks in the same proportion as the index. So for example, Reliance has a 10% stake in the index. 10% of your corpus will be invested in Reliance. If 5% is in say Infosys, we buy 5% Infosys. That's how we do it. So whole objective about an index fund is to replicate the returns of the index and nothing else. The reason why index funds are actually becoming a lot more popular is because they're a lot more low cost. Also, there's a misconception that there's only 2 or 3 indexes. There are actually hundreds of indexes. In fact, globally, there are thousands of indexes. So there are indexes across large cap, mid cap, small cap, multi cap. So I do think that I think there are a lot of options out there, and the space is only evolving in India. So that's typically what an index fund is.
Okay, sure. So I think you did mention, you gave examples of indices and how index funds then replicate them. But if you look at the examples that you spoke about, which is Sensex and Nifty, they're not truly diversified. Sensex has a 29% weightage to financial services. Nifty 50 is also financial services heavy. Doesn't that increase the risk for the investor?
Yeah, it's a great question, Rajat. So the index is actually a very beautiful thing because the index does not stay stagnant over a period of time. So let me give you an example. In 2004, the index was industrials, was materials, was I think capital goods. Today, the index is financial services. Tomorrow, it may be media or telecom. So the idea behind buying an index fund is actually buying the top performing companies at all points of time. The index actually rebalances itself every 3 to 6 months time, which makes sure that you're always holding some of these companies in your portfolio, and the weightage allocation will differ. Today it might be financial services, tomorrow it might be something else. So I do think that, and if you look at stock picking, so most of the stocks today, I would say maybe 70-80% have not gone back to the highs of 2007. But the index has gone up 2.5 times since then. So the idea behind index strategy is to basically let the market be your fund manager, let the market decide what will do well, what will do badly. Yes, today I agree, the index is heavily weighted on financial services, but obviously that may or may not change over the next 10 to 15 years time. In fact, India is one of the few countries where we actually have a lot more sector diversification than other countries. If you look at, say, China, if you look at Russia, look at other countries, they have a lot more sectors that play a much larger role in their GDP than, say, India does. So I do think that, yes, the indexes evolve. The whole idea of an index fund is to let the market decide which the big companies are, which the small companies are. And because of the quarterly or semi-annual rebalancing, you're making sure that you always hold the best possible companies.
Sure, sure. So, Pratik, you mentioned rebalancing and quarterly that happens or 6 months that happens, and it leads me to the next question. And this is one flip side that is often highlighted is this lack of active management. Is that you have to wait for the index to make a change to exit and stock. Now, a lot of times that might be too late if there are certain developments that happen. For instance, what happened in Yes Bank's case, when it actually hit rock bottom and the index changed, removed it after that. Even happened in PNB's case. What are your views on that? Does that not ultimately affect the returns that the investor is generating from investing and taking this approach?
So not really. So in fact, what we've seen is that when it comes to managing your money actively, yes, I think when things are bad, then you obviously you have an option to, I would say, sell those stocks at a much early opportunity as opposed to an index. But there is no. But on the flip side, if you think about it, most of the activities of selling a stock happen post hoc. Post Yes Bank going down or post I think DHFL going down. And the beauty about the index is that as the stock goes down, it becomes more and more insignificant. Just to give you an example of Yes Bank, Yes Bank obviously was a large company, but as it went down and down, I think the impact of it on the index goes also down. In fact, when it was sold out of the portfolio of an index fund, I think it had say less than 1 or 2% exposure or something like that. So I do think that I think indexes. The reason why indexes are great is because they tend to also get the stocks which are doing well early on. So for example, most people ended up buying Reliance say last year or maybe this year, after it's run up so much, because now they sort of see that it's a good strategy. But if you'd already participated in the Nifty 50 index, you would have bought Reliance, all the time. So you would have played the entire game much earlier on. So it can actually work both ways. You can actually get future leaders at a much early opportunity, when they're growing, as opposed to buying it much later. And obviously, yes, as the stocks go down, obviously it means less and less significance over time. In fact, as the stocks go up, it's the opposite effect. It gets more and more important, and it has a much higher weightage in a portfolio than it was a smaller company. So I do think that this self-rebalancing that the index does makes sure that the poor companies get less significance and the good companies get more and more significance over time. And which is why I think, if you look at, say, maybe not India, but look at the US, or if you look at Europe, index funds are actually doing better than most of the active funds, because they follow this very good strategy, apart from obviously the low costs, which are saving fees for the investor every year.
Sure. So we gave an example of Reliance, Pratik, and it again leads me to another question right now. If you look at what is happening now, a lot of money is chasing the select stocks, right? Big companies are getting bigger, and people want to buy those quality companies now. Because of that, these stocks, because of their demands, start to get overpriced and move their P's move above their long-term averages. Now, as an index, a fund, you don't have the option of not picking a stock which is clearly overpriced right now, or even the market as an overall, and you can't even take a cash call while you are an index fund. How detrimental it is to long-term returns, or does it affect the returns for an investor because of this constraint of you not being able to stay away from a momentum stock or something that is just running up for whatever reason it might be?
No, so I think so ideally you're buying the index. So, I think I don't know if momentum. So index doesn't have any strategy. Index is basically a market cap weighted strategy. Index does not have momentum. Index will not choose. So people are choosing between growth and value. Index, it doesn't really matter if you're choosing growth or value, because index will. So today the index is growth oriented. A lot of growth stocks actually gain prominence. But if tomorrow suddenly it switches to value, the index will suddenly replicate more value. So I do think that the index is great because I think the reason why active funds tend to do better and worse is because they follow a certain strategy. So we've all learned that it's very difficult to have an active fund outperform the index year over year. There will be bouts of underperformance and outperformance, and whereas I think the index is something which is stable. The index decides, okay, this is what's working. This is what I think the index is. So I do think that as a strategy, it's a lot simpler for the investor today. He doesn't have to make a call or trying to choose between 5,000, 10,000 active funds. And even after buying that, the problem with Indians is not really the process; it's about the behavioral aspect. So people tend to sell underperforming fund and buying outperforming funds. That entire culture of buying top performing funds is not really very prudent. And I think the average holding period of the mutual fund in India is like 2.5, 3 years, which is actually very concerning. So I do think that index makes it simple, because you'll never have the risk of, or you never feel that you picked the wrong fund. So in fact, what we've seen is, at least, so we've been running index funds for 9 years, that customers end up being very sticky. So they're never disappointed, because they're always, it's never really underperforming as a strategy. So I do think that, I think in terms of managing psychology, I feel that index funds are a lot simpler. Yes, if someone wants to take a call on momentum versus growth, then obviously index fund is not the right strategy. But in terms of just getting pure market exposure and let the market decide what will do well, is also a great strategy. Which is why what we are telling investors is to have at least 20, 30, or maybe 30 or 40% of your portfolio in, say, a passive strategy, and don't touch it for, say, 10, 15, 20 years. Let it run. And then if you want to also, obviously, buy these opportunities, and you can go and play around with your satellite portfolio, where you can go out there and buy your high performing funds. So I think a combination of these two is actually great for investors, because if you're only buying 100% active, then there might be a point of time where all of your funds are underperforming the index, which is not a very good sign. So I do think that I think the core satellite is something which we recommend, and I think it's more on the lines of simplicity than more than anything else. And I think it's harder to go wrong with index funds.
Okay, sure. So we spoke, Pratik, you mentioned about 30-40% to index and remaining inactive. The question related to it is that which part of your portfolio should go into index funds now. While almost everybody agrees that large cap universe is now very well researched, and it's going to become very, very difficult to beat the benchmark on a consistently. Mid and small cap space is still where stock picking is still the key. And plus, these mid cap funds can also take some exposure in large caps to bring that stability for proper returns. Would you then say that investors are better off of using index only for large cap allocation right now?
Yeah, no, I think investors should choose index funds based on, I think, what type of problem it's solving. So if you're looking out for a mid cap fund, and you don't want to choose between 150, 200 mid-cap funds, you can buy the index. The returns are pretty much in line with most mid-cap funds out there, and you can expect to hold on it for a very long time period. So I think simplicity is the key. I do think that, yes, historically we've seen that, yes, and I agree with you, the information asymmetry in the large cap space has gone down a lot. So the ability for you to beat the benchmark in the large cap space, especially if you're charging high fees, is much harder today than it was, say, 3 or 4 years ago. So I do think that, I think investors looking at a large cap strategy are probably not better off, but they should have at least one index fund in there to make sure that your returns are stable. But ideally, I think, the whole idea about index funds is to make things simple. And if you're looking for a multi-cap fund, and so a lot of new age investors are coming in, and for them to not really go out there and trying to pick the right fund, index fund make it very simple. It's effective, it's low cost, you can stick to it for a very long time periods. I think that's where I think at least the essence of index funds are at this point in time.
Right. So I think you also mentioned that people should look at what their need is and then pick up the index fund. So now there's also a choice in index funds, right? While there is no difference between how index funds are run, how should an investor should really go about picking among all the options available to him in the index fund category that he has?
Yeah, so I think when it terms of trying to pick the right index fund, I would say investors should look at two things. One is the expense ratios. The whole idea about index funds is to make sure that you track the index as closely as possible. It's a very and investors should know that you can't really get benchmark returns. There's always going to be a difference between the index versus your returns. There's going to be some difference every year. So I think try to find the fund with the lowest cost, because the lowest cost means there's less that's being charged to the fund, and the better your returns will be, and the closer your returns will be to the index. So that is one thing I would recommend investors to look at the expense ratio. The second one I would recommend is also to look at the tracking error of the fund. So ideally, funds which are lower tracking error tend to mirror the index a lot easier. than funds that are having high tracking errors. So I would say these two things are what investors should look at when you're looking to buy an index fund. In terms of choices, there are not. Fortunately, there are not a lot of choices in India. So unlike say the US markets, where you have hundreds and thousands of ETFs, hundreds and thousands of index funds. I think in India you don't really have that much. In fact, most of the funds are pretty much the same. So I do think that if you're looking for a large cap strategy, you have the Nifty and Next 50. Both are equally good. I think if you're looking for a slightly high growth portfolio, then the Nifty Next 50 might be good. Then you have obviously, I think in a mid and small cap space, I think Motilal Oswal, the only, even the multi cap space, I think we are the only index providers of index fund space. So I think investors can use our funds there. And also I think in the international space, I think every investor, regardless of, I think age, experience, risk profile, should have a minimum of 10 to 15% exposure towards international index funds, because it really lowers the volatility of your portfolio and gives you that actual diversification without sacrificing returns. So most diversification means you're buying debt, gold, real estate, where the returns are slightly lesser, whereas this is one asset class where you can get really good diversification benefits without giving up returns. So I do think that have an international strategy, have a gold ETF if you need a small proportion there, and maybe if you're slightly more on the riskier side, then you can look at say large and mid cap. Whereas if you want something really simple, then Nifty 50 or Nifty 100 makes a lot of sense.
So Prateek, you mentioned something called as tracking error. Can you just, and it sounds like a very technical word for most retail investors. Can you just explain what is the tracking error and how does it really ultimately affect the returns of the index fund?
Yes. Yeah. So tracking error is basically how well your portfolio, your fund is tracking the index. So if the index is up, say 10%, and if your fund is only up 9%, that is a tracking error. But most people actually don't understand, or most people do not, I would say, understand how tracking error is calculated. So tracking error essentially is a standard deviation of daily returns. So daily returns between the index and I would say the fund. And I think the lower the tracking error means the closer the index is tracking the fund. So I think look for tracking errors that are as low as possible. There's a lot of misconception is tracking error is the difference between returns of the index versus returns of the fund. That is not true. That is there is not really a term for that. But ideally, look for a lower tracking error fund. I think a lot of funds that have completed 3 years, they have to disclose it in the fact sheets. So I think you can use the fact sheets to figure out tracking error. A lot of newer funds out there, you have to give some time to them to be able to develop a good sort of. So ideally, you shouldn't look at tracking error from a 3 year or a 6 year perspective or a 6 month perspective. It has to be on a 2 or 3 year or 4 year perspective. I think that is where a fund really demonstrates how good it is in terms of tracking the index.
Sure. Perfect. So we've come to the end of the interview, Prateek. Any last word for our investors?
Sure. Sure. So, so my last word would be, I think, these are very difficult times, and I would, I would say push investors to obviously have some liquidity, make sure that, your expenses are covered. But I also would push investors to not stop investing, so the good investors, the bad investors are aggressive in the bull run and conservative in the bear run. The good investors are the same, and the really good investors are aggressive in the bear cycle, and really conservative in the bull cycle. So I do think that it's important to be good. So if you have a certain allocation strategy, make sure you stick to it. Because ideally, at least what we've seen in terms of data is that there is a big difference between fund returns and investor returns. So I do feel that behavior gap is a lot. So ideally, a lot of us as investors, spend most of our time trying to figure out which is the good fund to buy, which is the right timing. But number one, what at least I've learned from 10, 15, 20 years is that you can't time the market. So it's very hard to figure out which is the right fund. Might as well have an allocation towards all asset classes and rebalance them. And number two, behavior is very important. Investing is 10% process, 90% psychology. So I think it's very important to not stop SIPs. It's very important to be continuously invested. And it's important to not react to markets. The reason why the markets give you higher returns is because obviously markets are volatile. And I think if you've seen, at least not India, but if you look at the US, the S&P 500 graph is there since the last 100 years. And you've had 2 world wars, you had an oil crisis, you had a Great Depression, and still the markets have done absolutely phenomenally well. So I do think that, think long term and be disciplined, and please, I would say focus on discipline. It doesn't matter really what fund you buy and sell. What matters is, I think, how you buy and how you sell those funds. So that's my last word. Thank you so much, ET Money, for having me, and look forward to having more conversations with you guys. Thanks, Rajat.
Sure. Thanks, Pratik. Thanks for taking out time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.